Imagine you are just driving down the highway, right? And the unthinkable happens,
Yeah.
a sudden crash. And in less than the blink of an eye, this highly engineered explosive goes off inside your steering wheel.
Right.
It deploys an airbag, and it basically saves your life. Now, you would probably think the company behind that flawless precision explosive is, I don't know, some massive automotive giant.
Or a dedicated defense contractor.
Exactly. But it's not. It is actually a century-old Japanese company that, get this, started out making the plastic for old Hollywood movie films.
It really is wild when you think about it.
It is. So, welcome to the deep dive. For today's special Japan Stock Podcast edition, we are looking at Daicel Corporation.
Yes, we are.
And our mission today is to decode this century-old titan. We need to figure out if its underlying financial engine is actually built to survive the incredibly turbulent global headwinds we are seeing right now.
Yeah, and doing this deep dive, it really forces you to completely rethink what a corporate lifespan looks like.
Right.
Usually when we analyze a chemical manufacturer, the market expects a certain, static rigidity.
For sure.
You picture this sprawling, rusty industrial plant pumping out the exact same basic raw materials decade after decade.
Just completely at the mercy of global commodity cycles.
Exactly. But Daicel just completely shatters that static picture. They have undergone this, frankly, theatrical drama of adaptation.
From like celluloid film to the optical layers in your flat screens, all the way to those life-saving pyrotechnics we just talked about.
Right. So let's unpack this and figure out who they actually are today.
Yes, please. Because it's a lot.
It is a lot.
Yeah.
So to do that, we have to strip away the noise.
Okay.
If we apply the 80-20 rule and focus purely on the massive profit drivers, Daicel's true identity becomes very clear.
So we are ignoring the minor stuff.
We are completely ignoring their minor subsidiaries and the defense sector they deliberately withdrew from.
Got it.
The real footprint, the absolute core of their revenue, sits in three massive buckets.
Okay, what's bucket number one?
First, engineering plastics. This drives nearly half of their total sales.
Wow. Okay.
Yeah, almost 50%. Second is the acetyl chain.
The acetyl chain.
Right. These are materials and chemicals like cellulose acetate. That makes up about 26%.
Okay.
And third is their safety segment. Specifically, those automobile airbag inflators, which accounts for roughly 15%.
So what does this actually mean for you, the listener? Let's translate those technical buckets into the real world.
Yeah, let's do that.
Because Daicel isn't just a chemical manufacturer. I mean, they are essentially the invisible skeleton, right? The invisible skeleton and nervous system of modern life.
That is a great way to put it.
Like, if you smoke a cigarette, the acetate tow in that filter.
That's a Daicel.
Exactly. When you look at the incredibly sharp LCD screen on your smartphone or your TV, those tack films.
Right, the specialized protective layers.
Yeah, the ones that keep your screen from warping or glaring. That is Daicel.
And of course, a split-second explosive mechanism in your steering wheel.
They are just hiding in plain sight in the products you interact with every single day.
And what's fascinating here is how they acquired that presence.
Especially in the automotive safety space, right?
Yes, because they weren't just handed their airbag inflator business. We have to look at the historical scars that became their modern armor.
Wait, hold on. This is where I really have to push back a little.
Okay, go ahead.
Because mixing liquids in a giant vat is fundamentally different from assembling a split-second mechanical explosive.
It absolutely is.
So how did a chemical company not fail miserably at mechanical engineering?
Well, it's a fantastic question because you're totally right. Chemical manufacturing is what we call a continuous process.
Right. Fluids and pipes.
Exactly. You have fluids flowing through pipes under pressure 24/7. But manufacturing an airbag inflator is discrete manufacturing.
Meaning piece by piece.
Yes, you are building things piece by piece on an assembly line. It requires extreme precision mechanical assembly.
Yeah, because it has to work perfectly.
Right. You are building a device that must trigger instantaneously, perfectly, and only once under extreme duress.
So the margin for error isn't just small.
It is absolute zero.
So how on earth did they bridge that massive gap?
They took the strict, obsessive methodologies they had already mastered in chemicals, and they forced them onto mechanical assembly lines.
Oh, wow.
Okay, yeah, think about it. In a chemical plant, you have sensors constantly monitoring pressure, temperature, flow rates.
Because if you don't, the plant literally explodes.
Yeah, exactly. So Daicel took that 24/7 continuous monitoring mindset and applied it to discrete mechanical assembly.
That is brilliant.
They cross-pollinated their chemical process control with mechanical engineering, and that allowed them to spot like millimeter defects in airbag inflators in real time.
So they essentially weaponized their chemical discipline to conquer the inflator market.
They absolutely did.
Man, that is just such a bold pivot. They didn't just learn a new skill, they applied their entire century of chemical DNA to a mechanical problem, which, I guess, leads us to the broader question of their economic moat.
Yes, their competitive advantage.
Right. When we pit them against their competitors in this virtual battle of the markets, why did they win?
It basically comes down to structural dominance.
Okay, how so?
Take their chemicals business. Daicel is the only domestic producer of acetic acid in Japan.
The only one.
The only one. Every other standard chemical manufacturer in the country is relying on the highly volatile global market to buy this fundamental building block.
Wow. Okay, so Daicel's moat is that unbroken acetyl chain we mentioned earlier.
Exactly. They control the entire process from the base chemicals all the way down to highly specialized, high-margin derivatives.
They aren't at the mercy of upstream suppliers.
Because they are the upstream supplier.
Let me visualize this for you, the listener, because I think it's crucial. Think of it like building a skyscraper, right?
Right.
But instead of buying steel from a volatile, fluctuating global market, you own the iron mine, you own the forge, and you own the construction company. If global steel prices suddenly spike, your competitors go bankrupt trying to secure materials, but your costs haven't changed.
Because you own the mine.
Daicel owns the iron mine, and not only do they own the mine, they run a virtually flawless operation through something they call the CCAPD cycle.
Yes, this is huge. We all know the traditional PDCA cycle, right?
Plan, do, check, act.
Right. It is the absolute gospel of corporate management globally. But Daicel flipped it.
Flipped it how?
They use catch, assess, plan, do.
Catch, assess, plan, do.
Yes. And that subtle shift is their secret weapon.
Okay, I mean, it sounds a bit like corporate jargon. What does that actually look like on a factory floor?
Well, let's use a real-world scenario. Traditional PDCA says, let's plan to manufacture 100 tack films an hour.
Okay.
Then you do it, you check the results, and you act on the shortfall. But traditional planning often assumes perfect conditions.
Which never exists.
Exactly. Daicel's CCAPD cycle says, let's catch the messy reality first.
Oh, I see.
They mandate that their engineers capture the raw data before anything else. They might catch that a machine currently jams every 45 minutes, specifically because of afternoon humidity.
Okay, so they assess that messy reality before they ever draft a plan.
Yes.
They are essentially curing the disease instead of treating the symptoms.
Exactly.
Because they look at the ugly truth of the factory floor before drawing up some pristine whiteboard plan.
And this Daicel production innovation methodology is so effective, it gives them unparalleled yield rates and quality control.
Right.
And you really see that dominance in their tack films for LCD screens. They are just relying on a good process. They have built a massive geographical advantage.
Well, yeah, because the vast majority of their display customers are based in Asia.
Precisely. Daicel is perfectly positioned right in their backyard.
Right.
Add to that their unique multi-product formulation structure. This allows them to tweak optical properties.
Like adjusting how light passes through a screen.
Exactly. For different clients on the fly, they become incredibly sticky to their customers.
Because for a competitor to unseat them, they wouldn't just have to build a cheaper, faster plant.
No, they would have to recreate a century of formulation data and physically rip out deeply established Asian supply chains.
Which is nearly impossible. So, okay, they have built this massive fortified castle in Asia.
Yeah.
But cutting costs and dominating a region only buys you so much. To actually survive this hostile environment, we have to look at the geopolitical chessboard.
We do?
Let's talk about their global exposure, starting with what looks like a major opportunity right now, which is China.
Right. If we look at the resilience of their Asian operations, the China opportunity is a massive upside.
Really? How so?
Recently, China implemented a consumer goods trade-in program.
Okay.
And because of this, we have tracked a massive spike in demand for smartphones and personal computers in the region.
Ah, which directly feeds Daicel's electronics materials segment.
Exactly. And they are aggressively capitalizing on this with physical expansion.
Building new facilities.
Yes. They opened a brand new engineering plastics plant in Nantong, China, back in November 2024.
November 2024. Okay.
Furthermore, their new Taiwan plant, built to expand production capacity, reached full-scale operation in May 2025.
Wow. So they are planting physical flags exactly where consumer demand is heavily concentrated.
They really are.
Wait, hold on. You're talking about this massive Asian expansion, but retail investors are watching Washington closely right now?
Yes, they are.
Isn't this incredibly optimistic given the situation in the U.S. and the looming tariffs?
It is a vital challenge, and you are absolutely right to push back on that. We have to issue a preemptive warning here regarding the U.S. market.
Yeah, because it's impossible to ignore.
The shifting trade policies, specifically the tariff structures, often referred to as the Trump effect, present a severe recession risk.
Right.
If heavy tariffs are implemented on imports, it disrupts the entire global supply chain.
It's effectively a massive tax on the supply chain.
Exactly. And that can completely crush consumer demand for the very cars and electronics that Daicel's materials go into.
Right. I mean, you really have to let the gravity of that sink in. If that demand dries up, their entire Asian expansion could be left, just hanging out to dry.
Well, the interesting thing is Daicel's management knows this.
Okay.
They are explicitly modeling for these exact scenarios. The reason they are building plants in specific regional hubs like Taiwan and China isn't just about expanding their footprint.
What's it about then?
It is about securing localized regional supply chains. They are trying to build contained ecosystems.
Oh, okay, I see.
Yeah, so if a massive trade wall goes up between the U.S. and Asia, Daicel's Asian plants can still seamlessly supply their Asian customers without crossing heavily taxed borders.
They are isolating their markets, so a tariff in one hemisphere doesn't shut down production in another.
Precisely.
That's smart. But even beyond the U.S.-China friction, there are so many geopolitical ifs that impact their bottom line right now.
Oh, absolutely. If we connect this to the bigger macro picture, the sensitivities are immense.
Like what?
Take the ongoing friction in the Middle East. If the Strait of Hormuz faces a prolonged blockade, the logistics disruptions and the soaring costs of raw fuels immediately hit Daicel.
That makes sense.
Plus, the depreciating yen adds an incredibly complex layer.
It's a classic double-edged sword for Japanese exporters, isn't it?
Exactly. Since Daicel has a massive overseas sales ratio, a weak yen inflates their repatriated earnings on paper.
Right. When they bring those foreign dollars back to Japan, it looks like a huge windfall.
Right. But simultaneously, that same weak yen acts as a brutal tax on the cost side when they have to import raw materials and fuel into Japan to run their domestic plants.
Which means we really need to see how these macro forces are actually impacting the engine room.
Yes, the financials.
Let's crack open the absolute latest data, the Q3 results for the fiscal year ending March 2026.
Let's do it.
Because this is where the narrative hits the hard numbers and the story gets a little complicated.
It does. The numbers tell a very specific story of the macro environment we just discussed.
Lay it out for us.
In Q3 of the fiscal year ending March 2026, Daicel's consolidated sales revenue reached 432.5 billion yen.
432.5 billion. Okay.
Right, which is up 4.4% year on year.
To put that in perspective, they effectively bolted on a mid-sized chemical company's worth of new revenue in 12 months.
That's a good way to look at it.
Yeah.
They are selling more. However,
Here's the but.
their operating income actually slipped to 43.2 billion yen, which is down 2.8%.
Okay, so sales are up, but profits are down.
Yes.
The revenue growth is essentially getting eaten alive.
It is the textbook definition of a margin squeeze.
Right.
They are generating more top-line revenue, but the soaring costs of raw materials, fuel, and global logistics are eating into the bottom line faster than they can outrun it. And this directly impacts their EPS, earnings per share, and their ROE, return on equity.
Because you can sell all the engineering plastics in the world, but if the cost of the fuel to run the plant and the ships to move the product have skyrocketed, your profitability metrics just take the hit.
Exactly. ROE tells an investor how efficiently management is using their money, and right now the global environment is actively fighting that efficiency.
So how do they fight back? Because this isn't a company that just sits there and takes a margin beating.
No, they don't.
When you look at their defensive strategy, they aren't just vaguely, reducing costs like every other corporate press release claims.
Like,
They are violently pruning their operations.
they really are.
Let's look at that airbag inflator business, which we know is incredibly hard won.
Yeah.
They are currently consolidating their product lineup from 144 products down to just 85 products.
That is a massive aggressive reduction.
They are cutting the menu by nearly half. And by doing this, They dramatically slash their inventory bloat, they simplify their procurement costs, and their assembly lines don't have to constantly retool for wildly different
It's
modules.
all about focus.
Exactly. They are actively trading unnecessary variety for hyper-efficiency. And you see this ruthless optimization in their subsidiary, Daicel as well.
Yes, you really do. Looking at those key three March 2026 financials, Daicel net sales were actually down 13.9%.
Which sounds bad at first.
It does. But if you look closer, this wasn't a failure of market demand. It was a planned strategic optimization.
Ah.
In July 2024, they deliberately transferred their resin compound business over to an equity method affiliate called Novacell.
Let's translate that for the listeners. An equity method affiliate basically means Daicel still owns a piece of it and shares in the profits, but they get to take that bloated lower margin revenue off their primary books.
Exactly. They intentionally shrank their own top line.
That is bold.
They did. They removed a highly cyclical, lower margin segment from their primary operations to streamline their focus.
So they are willing to take a hit on total gross revenue to ensure that the revenue they do keep on the books is highly profitable.
That's exactly their strategy.
But, cutting costs and shuffling subsidiaries only buys you time. To actually survive this hostile environment, they have to reinvest that protected cash.
They do.
Where is the money going? This brings us to their capital allocation.
Right. So if we look at management's financial blueprint, they're projecting to generate a staggering 470 billion yen in distributable cash flows between fiscal year 2022 and fiscal year 2026.
470 billion yen.
Yes. For an industrial chemical company, generating that level of free cash flow is highly unusual and well above standard industry averages.
So they have a massive war chest.
Yes. And the truth of a company's priorities is always found in how they deploy a war chest of that size.
So are they genuinely shareholder first, or are they just checking boxes to keep institutional investors quiet?
It is a deeply calculated split. This massive 470 billion yen isn't just sitting in a bank account losing value to inflation.
Right.
It is being violently deployed across three fronts.
Okay, what are they?
First, next-generation growth investments.
Which covers the aggressive new Asian plants in Nantong and Taiwan that we discussed.
Exactly. Second, aggressive debt repayment to lower their leverage and protect their balance sheet from rising interest rates.
Very smart in this macro environment.
And third, robust shareholder returns through dividends and buybacks.
Okay.
But the underlying philosophy driving all of this is a concept management calls asset compression.
Asset compression, which is honestly really just a fancy way of saying they're aggressively selling off their bloated, low-margin businesses to focus strictly on the highly profitable stuff.
That's exactly what it is. The ultimate goal here isn't just to be a massive, sprawling conglomerate. It is to maximize ROIC, return on invested capital. Every single yen retained inside the company must justify its existence by generating a high return.
And if it doesn't?
If a business unit isn't clearing the ROIC hurdle, they sell it, spin it off, or shut it down.
Just like we saw with their deliberate withdrawal from the defense sector.
Yes. And we just saw again with the resin transfer to Novacell in July 2024.
It is a lean, mean, chemical-producing machine.
It really is.
But as much as we love this drama of adaptation, we have to put our skeptical lead analyst hats on for a second.
Always.
What is the blind spot here? Where is the gap in the data?
This raises a very important question, and it's the professional prudence required of any retail investor analyzing this space.
Because you cannot just be a cheerleader.
Exactly. Daicel's primary stated defense against global inflation and geopolitical friction is what they politely call appropriate revisions of sales prices.
Meaning they just pass the increased costs directly onto the customer.
Right. If their raw materials go up, they raise the price of their engineering plastics and their airbag inflators.
And so far, that's worked, right?
It has. Because of their structural dominance in that unbroken acetyl chain, customers have accepted it.
Okay, so what's the problem?
Here's the critical blind spot. What happens if U.S. tariffs and global monetary tightening trigger a hard economic landing?
Ugh. You cannot pass costs onto a customer who has completely stopped buying.
Exactly. If the music stops, if consumer demand for cars, smartphones, and PCs suddenly snaps, Daicel could lose its pricing power entirely.
Right, if automakers drastically cut production because the consumer is tapped out and no one is buying cars.
Then Daicel's inflator and engineering plastics segments take a massive hit.
Wow. Yeah.
And no amount of internal cost-cutting or CAPD cycles or asset compression can replace vanished global demand.
It's out of their hands at that point.
Completely. This is the gap in the data. This is why an investor might pause and wait for absolute clarity on global trade policies before rushing in.
It all comes back to that underlying tension. I mean, they have built an incredibly efficient machine, but the geopolitical environment around that machine is getting incredibly hostile.
It really is a precarious balance.
So as we wrap up today's deep dive, here is something I really want you, the listener, to mull over.
Let's hear it.
We spent a lot of time talking about how Daicel is perfectly positioned to survive the current trade wars through regional supply chains and asset compression.
Yeah.
But think about the longer horizon. As the world rapidly shifts toward electric vehicles and, crucially, autonomous driving.
Oh, that's interesting.
Right. A future where vehicle crashes might become exceedingly rare. What happens to the airbag inflator business that currently provides their highest margins?
That's a massive shift in their core market.
Will Daicel have to pull off one more theatrical adaptation for the AI age?
It is the ultimate stress test for an industrial giant.
Yeah.
Can the scars of the past protect them from a future where their core product might no longer be needed?
It really is a fascinating question to sit with. And, we'll see how they handle it over the next few years. Thank you for joining us on this exploration, and we will catch you on the next deep dive of the Japan Stock Podcast.